Welcome to the Modcast with Gary Roth, co-founder and co-CEO of Modern Wealth Management. Gary, say hello.
Hey, everyone. Thanks for tuning into our show.
Yeah. Hey, I'm Jason Gordo, co-founder and president of Modern Wealth. And there's a third guy here. His name's Mike Capelli. He is the co-CEO along with Gary Roth. Hey, the Modcast is here. We're super excited to talk to you about building and growing an RIA. Specifically, what are the challenges you might face? How do you grow an inorganic strategy? And what is inorganic? What's organic growth? How's it calculated? What does it mean? Why should you be concerned? So we're going to talk about all of those things. We'll talk about technology and the platform and building a great company. That's what it's all about. We're going to dig into all kinds of topics. We'll have guests along the way. We'll answer viewer questions, but this is going to be a lot of fun. So Gary, tell us more.
Well, I think we're going to do this as sort of a real-time behind the scenes. We're building a company. We're into our journey, which we're going to tell you a little bit about where we are today to orient you, but it's going to be a little bit of as we go along behind the scenes, behind the music, if you will, of how we're building things, including our views on the industry in general, and maybe some ideas that could be helpful to advisors and people who are building other companies. And we hope it's interesting, hopefully fun and entertaining. And we'll tackle a whole bunch of different things as we go along. And as we get into future episodes, we may even have some special guests. So looking forward to launching this.
Yeah, the awesome thing, so we had some pretty fun music on the way in, Gary, right? The little intro music that you heard on the way in to our viewer. Tell us how you picked that particular piece of music to introduce the Modcast.
Well, I just, in the interest of not being self-serving, I didn't pick it. Our head of marketing,
come on, Gary,
and producer,
come
Paul,
on.
He said, "Hey, what if we use this song, which was a song by a band that I was in the 1980s called The Reply, which I was the singer and bass player. And I wrote that song probably when I was 15. We recorded it somewhere when we were like 16 or 17. And but the great news about it is it's royalty free because I wrote it, so we didn't have to pay for it.
Right, we were looking for cheap music, and our producer happened to find great cheap music that you were the writer, you were the composer, you were the one putting it together.
I did.
Yeah, it's awesome. So, interesting little fact about Gary Roth, just as we get started on the Modcast. This is episode number 1, and we can't wait to kind of talk to you a little bit about who we are as a firm today at Modern Wealth Management, our humble beginnings, how we all came together, how we got to know each other, and our journey in the industry. We'll get into personal stories. We'll get into, again, some guest features. We're going to just have a lot of fun along the way. But mostly, it's all about how to build a great company, how to build a wonderful RIA, one that is growing, whether that's inorganic or organic. And again, we'll define all these terms that the industry likes to throw out as you kind of go along with us on this journey. So I'm going to give you a little bit about Modern Wealth, then we'll talk into what we were doing before Modern Wealth, and then we'll come back to the firm and really talk about where we're headed. So, Gary, what do you think? Is that a fair agenda for today's session, or number 1?
Yeah, let's dive into it.
All right, awesome. So as we got launched in kind of the spring of 2023, that was our official launch. We'll take you back in time a little bit later in the episode and kind of give you how we got prepared for that launch. But we launched in April of 2023. We were able to go out and acquire 3 great businesses in our space, all RIAs, 2 in the Kansas City area, 1 up in the Detroit, Michigan area, Troy. And that was our launch. We had a great equity commitment from a wonderful private equity partner, Crestview. They gave us a $200 million equity commitment to get launched. And between, a little bit of money from Mike, a little bit of money from Gary, a little bit of money from me, and that equity commitment from Crestview, we were able to get started. And that was 23 months ago now. And since then, we've been able to...
It didn't feel like a little bit. Sorry, Gordo. It didn't feel like a little bit.
It didn't? A little bit of money.
A
Well, it was a
little bit.
lot of money. Yeah, you're right. It was a lot of coin, but we've done a good job with it. So since the launch in April of 23, that first year we were able to bring on 5 assets. We ended 2023, December 31st, with 5 office locations, $2 billion of AUM, and about 62 employees. And we were launched. We were off and running. And in 2024, we had an amazing year. We were able to complete 8 acquisitions, build an organic growth hub to scale our business with. We'll talk a lot about the organic growth hub as we go through this. We brought on amazing management team members. We were able to find exceptional partners in the industry to join us. And so the firm at the end of 2024, after those 8 acquisitions and our organic growth hub build up and build out, we end the year at somewhere around $6.5, little more billion dollars of AUM, about 150 team members, and we have 4 transactions that we're in the process of completing now. So we're off and running. Our 2-year anniversary will be somewhere around a $9 billion firm, 17 office locations, and about 175, 180 team members. Gary, you're right. I mean, it was a lot of money, not some money, and it's been a lot of work, but it's been a hell of a lot of fun being on this journey with you and Mike. And I mean, we wouldn't have dreamt that we would stand where we stand today in the marketplace when we got launched. I mean, I don't know what your view is, but that's mine.
We'll get into this more a little bit today when we talk about the origins of modern wealth, and in future episodes we'll be talking about sort of the industry, how it's changing, what the landscape is today, and I think what that means for advisors and people running firms today. But I think the fact that if everything goes according to plan the next few months, and like we said, this is kind of the behind the scenes, so we're telling you things that are sort of internal, but without revealing names. That to be at $9 billion in 2 years is a reflection of how much the RIA space has changed over the last even 5 years. Because we'll talk a little bit about our backgrounds, but one of the pieces of our background is we were both part of the executive team at a company called United Capital, and that company was very successful. One of the originators of sort of the acquisition strategy that we see in place today in the industry, and one of the first what we would call integrated acquirers. And we built it over the course of 15 years. And after almost 15 years, we were at about 25 billion in AUM, which was a substantially sized RIA at that time in 2019. But just the space has just exploded. And now we see lots of RIAs where, they're in the 10s, 20s, even multiple 100 billion RIAs, like some of the largest ones that are out there, which was kind of unimaginable 20 years ago. When in United Capital's case, that we were launching that company. So it's been a really amazing journey so far at Modern Wealth. But I also think that we are, or I should say, and not but, maybe a little bit of a microcosm of how the industry, the RIA portion of the industry, is shifting in real time.
You know what was interesting is just this memory came back to me as you were talking. I recently found a pen from that from our United Capital days, right? And you and Mike were executive co-founders of that business. You were there from idea through launch all the way through the journey. I joined by way of acquisition. I had an RIA that transacted with United Capital in 2014. I had a business partner, and we had built about a $325 million planning first organization. I remember going to that first executive meeting, the managing director conference that next January of 2015. And the theme was 10, 10, 100, $10 billion or 10 years of work, right? You guys were about a decade old at that point.
Yeah, that's right.
When we joined, $10 billion of AUM, and $100 million of revenue is what the firm was hoping to get to in 2015. So to be kind of, really young in our buildup and be at $9 billion already at 2 years that's how radical the industry has changed.
Yeah,
These businesses have gotten bigger, that you can build quicker, to your point.
Yeah, it's moving at 5 times the speed or at 5 times the size, at the same age, however you want to look at it. And I think it's not just us, it's the industry as a whole. And it was part of what informed how we approached things when we launched Modern Wealth 2 years ago. So maybe we want to talk a little bit about kind of how we approach wealth management, and then maybe use that as a jumping off point to talk about how things have changed over the last 15, 20 years.
Yeah. So how do we approach wealth management here, Gary?
Well, we had a couple of core ideas that we started the company with around how we wanted to build the firm, which is how we are building the firm. Some of them were in the area of what is the client service model and what is the overall offering to clients. And some of them were around how do you grow the business internally, organically, beyond the acquisitions. So on the first one, we observed when United Capital was launched, this is in 2005, this was when the RIA space was pretty young. Most advisors, I'd say, most advisors still are in brokerage firms, but the shift from commissions to fees was just happening. The shift from wirehouses and independent broker dealers to RIAs really hadn't happened to the extent that it has. And the core thesis was be fee-based, one, instead of commission-based, and two, and this was kind of revolutionary at the time, charge a fee for financial advice separate from investment advice, and have the financial advice, the financial plan, be an ongoing living part of the client experience and your engagement with the client.
Yeah, and in the time period you're talking about right now is like 05 to 2012, 13, that period of time, like the launch of the old firm and really what the thesis of the business was, just for our listener.
And that was the shift. That was the change was, advising clients on their whole financial life, not just giving investment advice, but focusing on their goals, their dreams, their aspirations, what they actually wanted their money to do for them, as opposed to just, how to invest, what are my returns, how could I do better? That was a big part of that business. But over time, that really became just table stakes, for lack of a better term, in this industry. That's kind of like everyone's doing it. They're doing it in different ways. We had a behavioral finance approach. Some people do that. That's been incorporated in some broadly available tools now. It's no longer really unique. And we were told at the beginning, like, you can't charge a fee for advice. No one's going to pay a fee for advice. They'll pay for a financial plan. And then 5 years later, they'll pay for you to redo it, but they're not going to pay you on an annual basis. And now I think we coined a combined fee, which is, in a combined investment management and planning or advice fee is, I think, pretty standard across the industry. But as we were sort of in that transition period, 2019 and beyond, and here we might mention that in 2019, we sold United Capital to Goldman Sachs, and all of us were there for several years. When we all individually just kind of decided we wanted to do something else, or we didn't exactly know what we wanted to do, but we started thinking about what we wanted to do next. The business had shifted in a couple of meaningful ways, the RIA business. One, and this was already true by the time we were in the later years of United Capital, just doing investment advice and financial advice for clients was starting to become not enough. And we saw in particular businesses that had an integrated approach to tax planning and tax prep, but tax planning as part of the financial planning process, were doing really well. That's not something we did in the old company, but it was one of the things we put in, like we were kind of drawing up on a napkin. What would we, if we were building a modern RIA today, what would we do? We'd want to make sure we have an integrated tax teams and have that be an integrated part of the client experience. That, obviously as the population is aging in terms of, sort of the typical wealth management client, that, everyone might have an estate plan, but continuing to update and modify that plan as you evolve and things change has to be part of the experience. Risk management has to be part of the outgrowth of the planning process. And, as we grow, we'll get into other things, giving becoming an incredibly important part of the planning process, the liability side of the balance sheet. So we we said, we want to have a broader client experience as we build this firm. And it is part of what we're intentionally doing here. And other people are too. I mean, none of this is a secret. Everyone can go to everyone's website. Everyone can see what everyone's doing. And we
or what they claim to do,
or what they claim to be doing. And yeah, I mean, you never really know what you're going to get until you become a client of any firm. Right.
Right.
But,
right.
We think that was one big area for us. The other thing that was very obvious in terms of re-entering the space is what we were talking before about the speed at which we've gotten to the size we're at today versus, using the company we were last part of as a benchmark. Between, 2017, 18, 19, and now, the interest in the RIA space from private equity investors and other large pool investors has really, really skyrocketed. And I'm sure we could probably post on our site some statistics in terms of the quantum of capital invested, to use a term that an investor might use. But it's just really changed dramatically. And I tell people all the time, as successful as people view United Capital as having been, for most of the years of United Capital, the investor community was not really that interested. Like, they were not completely sold on the RIA marketplace, and it seems like that's changed pretty dramatically.
Well,
so,
I mean, speaking of change, you and I were just in a session in a kind of a study group just a couple of weeks ago, and one of the members of that study group shared with us the stat that there's currently 77 private equity investors in our space, in our industry today, right? And some of those have 2, 3, 4, 5 investments. Some of them have one, like our private equity firm, Crestview. But that there are 40 additional firms looking for quality teams to back in the space. That's how interested private equity is in the space today. And we could do a whole episode on why I believe and you believe that private equity is good for the industry. We probably should do that episode.
Maybe that'll be episode 4.
Yeah.
We've planned out through episode 3. And that number, someone out there has the number of, well, how many private equity investments were there in the space, in 2017 or 2015? But I'm sure it was a small fraction of today. And the size of those investments would be a fraction of what they are today. And so when you see, if to the extent listeners and viewers out there kind of follow the reports from the M&A, the merger and acquisitions advisors in the space, who publish sort of deal books and updates on how many acquisitions there have been every quarter, every year. And there's always charts that sort of show, going back to like 2016, 2017. And, the number of acquisitions has gone up like this. And it's directly correlated to the investment in the space, because that's a big part of the use of proceeds is for firms who have an idea, an investment thesis or management thesis around how can we aggregate more firms and do it in a way that's better for everybody, hopefully better for, the clients, better for the team members of the firms that are being acquired and the principals of the firms that are joining bigger firms. That is driving the acquisition marketplace, but it's obviously fueled by money. And without the money, it's not happening. Without the money, it would be what it was, 15 or 20 years ago, which is, Jason, you're in Monterey, California. There's another RIA down the street, probably, maybe one or two. And, maybe you guys get together and do a merger and buy each other out, or maybe you have a junior advisor.
It's what I did in 2011. Yeah. I mean, literally that exact scenario you painted. Yeah.
Or maybe you have 3 daughters, maybe 1 or 2 of them come into the business and you hand it off to them. That was the traditional path. And those patterns could still exist, but they're definitely being disrupted by capital. So that's a big trend.
Yeah, and capital. Let's talk about capital for just a second, because I think this is an interesting point. As we talk to potential partners every day, and there's so many generation 2 and 3 advisors in the marketplace today that are in RIAs that are very successful that can't afford to buy the business today, right? Like you oftentimes you can't just go buy that RIA down the street because these businesses have gotten to a size and the multiples have gotten to a point where it's really expensive to acquire the person down the street or sell it to the next generation or hand it off to your kids.
Yeah, and in the early years, like of not even in the early years, many of the years of United Capital being in the acquisition marketplace, a lot of times our competition for a deal was not another aggregator. A lot of times it was the alternative being, the G2 advisors in the firm buying, the founding advisor or advisors out with their own cash flow. And it would always be, okay, we're going to buy it at this multiple with a note over this period of time. And really what they were doing, which was an established practice, was just buying the practice from the retiring advisor with the cash flow from the practice. And it gave the retiring advisor a stream of income, for a number of years after they were, kind of at the point where they didn't want to work anymore. And that worked until, there were firms that came along who said, I can afford to pay more for this because I can make it worth more than what it is today, in a whole bunch of ways. And that and the making it worth more will be, I think, a major theme of this podcast as we go along. Because otherwise, it's like, well, what's it all for?
Yeah, why'd you do it? Why'd you do it if it's not going to get bigger?
Right. And I will tell you what is not a secret, which shouldn't be a secret, but if you're thinking about selling your firm, the acquirer is not buying your firm so that you can receive the amount of money that is the perfect amount for you. And they don't really know or have any idea how they're going to make it worth more to their own shareholders, right? Like the only reason for an acquirer to come in and acquire anyone is if they think it's going to be worth more to them over time. But certain things have to be true for that to be true. And otherwise it won't be worth more over time, which brings me to another thing we'll touch on briefly here, but we'll get into more depth in our next episode, which is organic growth. And one of the other pillars that we talked about in building our business plan when we were starting this firm, and by the way, I say the words business plan, and everyone knows like business plans are like, you write some things down. This is your intention. This is your thesis, and then you follow it. But of course, as Mike Tyson says, everyone has a plan until they get punched in the face. So, life always punches you in the face. So business plans are, it's a good reference point, but it immediately changes and evolves the second you start actually doing something. But hasn't changed is, we came into the space and maybe it's less about a business plan, more about just sort of experience and observation. This is an industry that, to put it bluntly, does not grow organically. And, when the studies come out, a year ago, it was like RIAs growing at, between 2 and 3%, depending upon which study you read. This year, they sort of said 3 and 4%. But that's an average. So, you don't have to have taken like advanced statistics to know or to think about it and realize if you take the firms that are growing at a really high rate, if there's a small number of firms that can invest a ton of money, and I don't know whose names we can say legally or not, but just say, firms you might see advertising on TV, because there are RIAs that you actually see advertising on TV now, national TV. There's only a small number that could afford to do it. But like, guess what? Their advertising budget is bigger than yours or mine, right? And presumably they're growing at a much faster rate than the typical firm. So if you take out the outliers on the high side, who are probably growing at, hopefully for them, meaningful double-digit rates, double digits meaning way more than 10%, right? Then the median firm isn't growing at all. And if you've experienced it, you know why. It's because, and we'll get into this in the next episode, but this is a business where you do have to walk, if not run, to stand still. Unless you have a very young client base, you probably have clients who are withdrawing assets every year, and you have some people who leave. So we'll get into that more in another episode. But one of the things that we said is, listen, we're going to take a very intentional approach at a nationwide level to organic growth to stimulate and hopefully help create organic growth in the offices that join Modern Wealth. And I think we'll probably devote more time to that in another episode. That was a big point for us in starting this company.
Yeah, I'll say the business plan, right? I recall a lunch meeting where the three of us got together and, in my mind, it was the yellow pad, right? A line down the middle. What worked really well in the last firm? What didn't work so well in the last firm? And then a line across the bottom, which was what are other firms out there doing that's interesting that we can either replicate, emulate, steal, like tax prep being one of those things, right? We just knew how powerful it was. So you're right. In the business plan, there's financial models and there's by almost the minute what you're going to do every day, all day long to drive the business. But really it's that yellow sheet of paper with what are we going to do in this business that we did really well in the last business? What are we going to avoid in this business that we didn't do so well in the last business? And then what are those things those big themes in the industry that have changed or evolved or pushing firms forward? And organic growth, I love it when we have those third-party M&A advisors send us what is called a SIM, and it says this firm is growing at 17 or 20%, and then the firm believes they're growing at 17 or 20% organically. And where the confusion is, look, moves in the market, not part of organic growth, either up or down, right? Let's define what is organic growth. Let's do it the next episode, though.
We're going to do that in the next episode.
Yeah, let's hold it for the next episode.
But can we do one thing though? Can we tell everyone what a SIM is? Just give a little inside baseball from the
it's like the pitch
world.
deck of this is a great question. It's a pitch deck of a firm that is on the market and available to transact with, right? So the M&A advisor, think of them as the realtor of the seller, right? So the seller has engaged this M&A advisor, and the M&A advisor, and we need to do an episode on M&A, like real consultants, kind of M&A decent consultants, and then auctioneers, and how to pick who you're working with, or how to figure out who you're working with, and how to avoid the auctioneer at all costs. But that's another episode altogether. So a SIM is basically the presentation of your business to a potential suitor, somebody who might be interested in acquiring that business. It's just,
so if you're an advisor out there, an advisory firm, and you're hiring a banker or third party to represent you and market you for sale effectively and find buyers or investors in your business, they're going to create a SIM. Now, the thing I wanted to get to, which I have always found really funny, is everyone refers to them as SIM. But what is SIM? SIM is an acronym for Confidential Information Memorandum. But confidential is a hard C, not a soft. So SIM sounds like S, right? So anyway, I've always thought it was very funny that but everyone calls it a SIM. No one mispronounces it. Unlike, I still don't know, is it GIF or GIF? I'm not really even sure, but
I don't know. But my wife is a professional at using them. I know that part. So back to growth though, like if in the SIM, in the document that says how healthy your business is, the advisor is representing your business as 15% grower, that's not organic growth. And we'll throw out lots of stats along the way during this podcast, this series, things that we are learning as we attend conferences and we meet with, senior people around the industry. But Chip Rome threw a stat out a couple of years ago at his conference that 77% of all new AUM flow goes to 6% of the firms, right? So when you were talking about averages of 2, 3, 4%, that's going to very few firms. Like very few firms are actually driving in the teens or even 20% net organic growth every year. And again, we'll define that in a future episode, the next one. So tune in because we'll be dropping that information then. But it means the typical firm is in the distribution phase of their business. As their clients have aged and they're taking RMDs, that business is suffering the loss of RMDs along with account values are shrinking, terminations occur, the clients are not being served in a modern and current way, not a pun, not a play on words. I mean, like, there is a modern way of running this business, doing this business, being in this industry. And there are a lot of firms that we encounter every single week that are not using best in class tools. They're not growing. They're not allowing the next generation to really step in and take a meaningful role in the business. And I'll tell you, when I walk into an office and I find a fax machine, I know that business has not been invested in a long time, right? They're not on current platforms. They're not doing it the current way. So a lot of this podcast, hopefully, is just helping advisors understand how to grow a profitable business. And all these businesses are profitable, grow it healthy from every year, provide healthy growth to the business, and just point out some of our findings around the industry. But all right, Gary, so what are we doing here?
Well, I think we're going to wrap this episode in a minute or two, but I think I want to touch on the word modern and what does it mean to us, and why do we call ourselves Modern Wealth? Because I've gotten a few questions. First of all, I mean, like a band, the most important thing is the name and logo. No, I'm kidding. But
well, I think modern because it's always current, right?
Well,
like if you're modern, it's always modern. It's never like old school. It's just always going to be modern.
So I think that's a big part of it, is the orientation is always looking forward and saying, what could we be doing to improve for all of our stakeholders, as people would call it, kind of in corporate land, which is, our clients, our team members, our advisors, their families. How can we be building a firm that kind of continues to address people's needs as they change and the world changes, as opposed to, because I think some people hear modern and they say, oh, it's all tech led, or, it's just a digital interface. No, it's a human interface. It's a human led experience. Technology in this industry today is always going to power things. It's almost impossible not to be powered by technology now. But what's the best sort of set of solutions for people to guide them as they move through their lives? And our goal is very simply to help our clients, our employees, and everyone involved in the firm to live a better life. And how can we create an experience that allows people to live a better life? So it's not just, higher investment returns. If you don't know what that means to you, or why you're getting them, or what you're going to do with it, it's not going to make you happier and not going to feel like you're going to live a better life. And of course, it's easy to quantify and count certain things. And then we do that in this business. But if we can help people live a better life, we will know that we have created a great company.
And that's what we focus on every single week. The way we run the business, the management team, just the ethos is all about having a lot of fun while at work, having a lot of fun while not at work, and really having the time and the energy to live well in both areas of your life, right? Your work life shouldn't drain you so that your life part of life, you need a nap and you're tired and you want to sit on the couch and recover, right? So everybody here, our weekly stress is, how are we moving people's lives forward, both clients and our team members, so that they can live that better life? And look, this is episode number 1. We're going to get into a ton of stuff over time. The next one's all about organic growth. We'll define organic growth. We'll talk about how we're driving organic growth. We'll talk why it matters to you that you're focused on driving organic growth. And we're going to have a lot of fun. And we'll take questions along the way, and we'll address those, and we'll answer those. And we hope that you find nuggets of wisdom and value in every episode as you think about how you build your firm and why you might want to join a firm like ours, and the right questions to ask when you're thinking about moving on. So I'm Gordo, that's Gary, and that's episode number 1. Hey everybody, thanks so much for listening to episode number 1 with Gary and me, Gordo. We've had a lot of fun. We're going to have a lot more fun in the future with more episodes, more content, lots of industry talk and lingo that we'll actually define a little bit. But thanks for listening. Hey, if you want to learn more about us, go to Modcast.show. That's Modcast.show. And you'll be able to engage with and talk with our team member, Casey. Casey Harrison is an awesome individual. And if you want some energy in your day, please hit Modcast.show. And again, thanks so much. If you did enjoy what you heard, like, share, subscribe. We'd love to engage with you. We'd love to chat and take you along on our journey. Thanks so much.